There is an ongoing debate at the moment about over economic policies, and in particular fiscal vis-a-vis monetary policy. And I think this debate has to do first with the perception that there are decreasing returns to monetary policy that has been overused over the last few years. And secondly, because there is a slowdown in growth that makes one expect, if not a crisis, a period of low growth rates. So the question is, what is to be done as regards monetary policy? You see, growth rates are coming down after a period of some recovery, but the expected growth rates are quite modest. From 3.7 in 2018, we are expecting now 3.2, slightly more than 3 in 19, and even closer to 3% in 20. And you see that we are coming from 5%, and this was the standard or the average for many, many years. So growth is slowing down, and the current policy consensus about policy consensus, meaning this is the mainstream. First, most likely, and you have seen the announcements of the ECB and some other institutions, monetary policy will continue to lead the counter-cyclical efforts, in terms of time at least. Secondly, although admittedly, as I said before, the effectiveness of monetary policy looks like diminished as compared with what it was a few years ago. And secondly, there is also the widespread acceptance that fiscal policy should play a bigger role, but the political environment and high levels of debt are constraining in some way or another its use. So what is the way out from these two opposing forces? Of course, there are proposals. There are proposals as regards monetary policy to review the strategy, and the Federal Reserve in the US is doing this, and the Bank of England is doing this, and the ECB will start doing it right after the change of leadership that has taken place last month. Some others propose changing also the notion of what fiscal policy should do during the crisis, and about the coordination between monetary and fiscal policy. Yesterday we had a very insightful lecture given by Lord Skidelsky. Maybe one could not agree with everything he said, but it was framed within some orthodoxy. But some other proposals, including the ones that we attended in the session before, would ask fiscal policy to go a bit further. So I will comment very briefly in order to frame the discussion about these issues. So on monetary policy, I mean, there is the sentiment that monetary policy is reaching its limits. There is, it is not proved. It has functioned to some extent in the past years. Quantitative easing, in spite of all the criticism, has contributed to growth very clearly, but central bank has become, all over the world, central banks have become more, I would say, non-standard as compared to the policy frameworks they were using in the past, resulting to innovative, no more, but non-standard tools. Quantitative easing, yield curve control, negative interest rate policies. You see, including at the current moment, the ECB, forward guidance, all kinds of new things. And in spite of all these innovations, you see on the right side that the inflation expectations are sliding down, and this is a source of worry, because once the markets don't expect anymore that the central bank will behave as announced. In the case of the ECB, and this relates to the Eurozone, getting close but below 2% in the medium term, and clearly we are drifting away from it. There is this worry about what the monetary policy can do. So we are facing a lot of difficulties for monetary policy. So after some revival of growth in continental Europe, we see again ahead of us a period of lower growth rates, around 1% or slightly more than 1%. And there is this sentiment that monetary policy is starting to fail as regards its primary mandate that I expressed before. Close to, but below 2% in the medium term. The reasons for this failure could be manifold, including a number of reasons that are far away from monetary policy, and this came before. So monetary policy is only one of the factors or determinants of the inflation, especially in the short to medium term. And monetary policy cannot do anything about, say, changes in pricing behavior due to technological innovation. And we are seeing a lot of it. Improvements on quality that are not reflected in the way we measure prices, or, of course, globalization, demographic trends, secular deceleration of productivity, or even some degree of secular stagnation of demand due to, say, the leveraging, or to other factors like inequality or aging that are driving savings to be systematically in excess of investment. So monetary policy is only one of these factors, but the fact that the mandate of monetary policy is linked to price stability as defined is eroding the capacity of monetary policy to deliver. And in fact, the Phillips curve that monetary policy used to exploit has broken down. Now the connection between output gaps and inflation is weak as ever, so implementation of monetary policy in order to deliver price stability is even more difficult. So there are, and this is why many central banks are reassessing the monetary policy strategy. In the case of the ECB, there are noises that they are aiming to a more symmetric objective. There is no talk yet about changing the levels of reference, but indeed they will come up with something that will remedy part of the problems. But those issues will remain with us for some time. So there's also, as you see, the conviction that at the moment monetary policy cannot do all on its own. That fiscal policy should play a bigger role. It is indeed true that in the past, and for quite understandable reasons, the reputation of fiscal policy as a stabilization tool was low. Quite frequently pro-cyclical, and on many occasions delayed. We know almost everything about the long and variable lags associated to discretionary policy, so this is why I would say the mainstream still sees fiscal policy framed within the rules, with room for automatic stabilizers, but some limitations in order to enact discretionary measures. On the other hand, fiscal stabilization in the past has been used quite frequently as an excuse to pursue political goals, and we know how hard it is to withdraw stimulus when needed. And this is, of course, political economy. Political economy underlies many of these discussions, and is not always at the forefront. The fact that you have to apply rules and to take decisions within a political system where there are some asymmetries, and this is why framing things in rules or using delegation in the case of central banks have and will remain having prominence. So in view of these limitations of fiscal policy as a stabilization tool, there are, I think, on the table at least three different proposals, and this just to provide a scholar way of presenting these things, which is, okay, if fiscal policy has not been contributing sufficiently in the past in order to increase demand and help monetary policy to do its sound job, let's resort to measures, meaning contained or disciplined, reasonable fiscal stimulus with low or zero interest rates. In the standard Keynesian textbooks, we saw that, or we remember that when monetary policy is at the zero or one or closed, the most effective policy tool would be fiscal policy. So this has connection with that. These days, what we can say about the measured fiscal stimulus is that maybe there is more room than it appears within the traditional sustainability analysis, given the fact that if rates are expected to remain very low for very long, because this has to do not just with the policies of the central bank, but also with demographic trends and the evolution of productivity, sustainability analysis has to take account of this, meaning that presumably the sustainable levels of debt are larger than we thought. And also at the zero-hour bounds, there are all reasons to expect that the fiscal multipliers would be bigger. So this makes the case for having a more prominent role for fiscal policy. This is option one, fully within the, I would say, orthodoxy. Option two is at the limits of orthodoxy, I would say, in the sense that maybe you are familiar with this proposal made by Bernanke for the case of Japan, or for Adair Turner and some others, including Stanley Fischer recently this summer, which is, okay, maybe as a last resort, in order to stimulate the economy, QE is in decreasing returns, the regular QE, maybe we can think of a, let's say, QE for companies and individuals, having an institutional agreement between the government and the central bank, whereby the central bank remains independent in deciding when and by how much dropping money in the real economy, say companies and individuals, on behalf of the government, and when to terminate it. The sole justification of this would be, again, ensuring price stability. So it's not about stimulating the economy or producing full employment. It's within the remit of the central bank, and the proposal is, look, it seems that our toolbox is almost empty, and maybe a way to ensure that we deliver on our mandate. Our mandate is that we credit a government account on our own decision by the amounts that we deem appropriate for stimulating demand. And of course, the key word here is permanent. So it should be a permanent increase, and sorry I missed passing this slide. The word permanent here is the key, because if people would expect this helicopter money drop to be temporary, to be compensated or withdrawn later on via taxes, they would probably keep the money to pay the taxes, so required an equivalence could emerge. If there is a way to anchor the belief that this transfer would be permanent, there is a high likelihood that this would be spent. Is of course more extreme and more non-conventional than the standard QE that we are now familiar with, but key to the function of this and to have this helicopter money approach within the orthodoxy is that there is an appropriate governance structure whereby central bank remains independent, deciding when, by how much, and when to terminate, pre-established. And of course, political economy is always there, so being non-conventional always creates the risk that it could be overused due to political pressures. And the central bank is not immune to this. And finally, we have MMT. MMT, to the difference of the two previous approaches, is not framing the orthodoxy, so it would be an heterodox approach to an increased use of fiscal policy. It is in this sense more extreme. One has to say that in spite of all the very assertive remarks that are made here and there recently about MMT, one misses a well-founded theoretical corpus behind it. It's not just models, it's kind of having a mainstream list of propositions, and secondly, that would be testable. So that we could see some sound empirical evidence that these proposals have some backing, because if one has to go to the experience of some countries, many of them emerging countries, in the past that have used an approach close to this MMT approach, the experience is not brilliant, meaning having ended up with hyperinflations or high levels of inflation and frequently changes in political regimes. I have in mind Latin America for the most part, but also at this side of the Atlantic. You may remember episodes during the Mitterrand government or the Schroeder government, when those ideas to have a very, very forceful fiscal policy put at the forefront had to be rolled back. So there is always this risk of inflation or hyperinflation, because again, political economy. What is the trigger telling you that you have to roll back all this stimulus is not obvious and not clear. How quickly would it work is obviously not clear. What is the NIRO? What is the trigger? And the difficulties, thirdly, to stop the dynamics of higher spending and lower taxes, be they financed with money or not, because the money finance, according to some proponents, only comes into the play when the government needs to assure very low rates or even zero rates for long, so to avoid the side effects associated to higher debt. But be it as it may, these difficulties would remain, especially so given that for the proponents of MMT, the independence of central banks should not be maintained, plays no role, so the central bank would be just an account of the government. So according to this approach, fiscal policy would be completely discretionary and the central bank would lose its current role. So to end up and make some room for the discussion, I think the main conclusions are clear. This debate, of course, open debate on fiscal and monetary policies is justified due to the fact that fiscal policy has been overused over the years and we are facing now a slowdown that may or may not end in a crisis. It is my belief, and of course is marked by my own experience and reading of evidence and also my experience in central banking, that fiscal policies should be subject to rules. You may reframe the rules, maybe some rules are stupid, as some Italian president used to say, but there is always a way to redraw rules that makes more sense, and this has to do with the notion of sustainability in moments of very low rates. Third, I think central banks should maintain their independence without this hindering in any way the democratic governance. Delegation is one more way by which democratically elected governments achieve goals. And finally, monetary and fiscal policies are not substitute, but rather complements appropriate growth policies. Growth is always dependent on the real things like TFP, so like accumulation of physical capital, human capital, and knowledge. So in the long run, this is what drives growth. And monetary and fiscal policy are only ways to complement this growth and make it smoother towards long-term trends. Thank you very much again for the invitation.